And so if we look at the cash flow component of that, it was whatever, $1,200 a year, call it, over 7 years. I don't know, 10 grand, 11 grand, something like that in terms of cash flow. But in terms of equity was hundreds of thousands of dollars over that same period. And so that I could then take and go invest into a cash flowing asset, which would be much more impactful than that $100 a month. What's going on, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today I'm joined by my co-host,
Tom Schneider.
And Tom, today you and I are going to be tackling 5 things that we wished we knew about real estate investing before we got started. So let's get into it. Tom, what's going on, man? Good to see you.
Good to see you as Michael. Very excited. Excellent topic today. Excellent topic.
I think it's a very timely topic. Timely topic. So, Tom, just get it started, man. Like, what's the first thing that you now know about investing after having been doing it for a while that you wished you had known before you got started?
Yeah, I would say a common theme for new investors is paralysis by analysis. Kind of inability to make a decision. And what I would tell myself is the importance of, or I guess the inevitability that some decisions are going to be good and some are going to be bad, and there's going to be a lot of value had even within the mistakes. That could be, selecting a property manager or selecting a house. Like, there's a lot of value to be learned even in those mistakes. And what I guess what I would hope to be the output of telling Tom in the past that is just being able to move a little bit more swiftly on making decisions and then moving forward and taking whatever those learnings were and applying them the next time around. So, really, this is about solving for paralysis by analysis and being able to confidently forward, even if it's not going to happen exactly how you want it to be or whatnot, but just having a bias for action.
Yeah, no, I think that makes a ton of sense. And I love that. And so if I could paraphrase, is that just basically saying to younger Tom, you're going to make mistakes, so live with that knowledge and just move forward?
Yeah, take the best information that you have, move forward, learn where there are mistakes, and not just, again, trying to kind of avoid that paralysis by analysis.
Yeah, I love that. I love that a lot. And something that I always share with newer investors is like, you will never buy the best deal possible. Like, there will always be a better deal and there will always be a better market. And so people ask me all the time, like, oh, how do I pick the best market? And how do I pick the best deal? It's like, well, you can't. You never will. There will always be a better deal. There will always be a better market. And your subsequent deals should be better than your previous deals. And so therefore, by definition, you can't go buy the best deal because your next one's probably going to be better. And if it's worse, then you maybe aren't investing in the right trajectory.
Yeah. And the, all the learnings from each of those cycles or, at bats, you're going to get something out of this. Yes. Yeah, Michael, you want to flip it around? You want to give your young Michael piece of advice? We'll just kind of alternate back and forth.
Yes, young Michael, Padawan. So something that I wish I could have told my younger self is that things, similarly to you, Tom, will go wrong. But this is from a physical property perspective. And so the need for reserves. So I think so many people get started in real estate thinking they just need their down payment and they can jump into the deep end of the pool and start investing. The reality is things will go wrong. They will go sideways. And so you need to have reserves in your bank account, sitting in cash, most likely, to be able to handle those rainy days. And this is just something that I wasn't prepared for when I first started investing. I had the reserves, but unknowingly, like I didn't have them earmarked for real estate investing. And so when things came up, I was able to afford those and pay for them out of pocket. But it was just a shock to the system in terms of, hey, well, this is what my pro forma or my model says I'm supposed to be allocating towards my first investment. And now I'm spending all this extra money. It can come as a real shock and a real surprise and catch people off guard. And so if you are not prepared for that or don't have an emergency fund, you can find yourself kind of stuck between a rock and a hard place pretty quickly.
Yeah. I'd say that's one of the real ways to get in trouble as an investor is just kind of have your hand, not the right reserves and hands in the cookie jar and all that.
Absolutely. As good as cookies are, keep your hands out of them.
Yes. Yeah.
All right, Tom, what's your next thing you wish you would have known as an early investor?
The next thing that I wish I had known, I say, is around the value of kind of going, this is going to sound kind of silly. It is like going the extra mile as it relates to relationships or like long. So I'll wind back a little bit. So a really important relationship that you're going to have as a remote investor is with your property manager. And, there's a lot that you can do in vetting them. And, Michael has all kinds of awesome stuff within his course, but about going the extra mile in, I think like recommendations and relationships are really important. So what I mean by that is if I'm selecting a property manager, like getting some actual referrals and like picking up the phone and actually calling those referrals. It sounds like easy, but I don't know. I find myself a little bit of like an introvert, and like those can be, it takes a lot of like mental energy to go do that. So, in making those relationship type decisions, this could be with a broker or an agent or a landlord or an insurance, kind of going the extra mile, in where there's really high value ways to evaluate them, like references is really important. And, within those references, having context like, oh, this is the person's brother, or are they like so I would say just kind of going that extra mile and the way in which you diligence specifically around like relationships. I think there's just like such major value in that.
I couldn't agree more. And I think too, what I failed to recognize, and probably maybe what you did too, is like, if you pick up the phone, if you spend the extra time to go pick up the phone and call that person's reference, like it takes 30 seconds, 2 minutes at most, maybe.
Mentally, it can be
to
hard
put in
though.
that work.
Like, I feel that like,
it can totally be hard. But what should I think drive people forward is that if they don't do that and then the relationship sours and it's not a good fit, to go change property managers is going to be way more painful than a 30-second or 2-minute phone call. And so I think I forget what the terminology is, like loss aversion is like what's going to drive people to make decisions and take action, is like the fear of making a bad decision, or the pain that comes with making a bad decision and having to change property managers, like should propel you to go do the seemingly inconvenient or seemingly hard things on the front end.
Yeah. I mean, measure of like ROI is extremely high, for that type of activity.
Yeah, absolutely.
All right, Michael, let's hear your number two.
Number two for me is that it takes a long time for real estate to appreciate or for value to be added on a particular property. Now, this is going to not really apply to flipping, because if somebody goes in, buys a house, can flip it in 3 weeks' time, you'd be like, well, it doesn't take a long time to add value. But for just traditional, slow and steady real estate appreciating, you doing nothing to the property, you're not forcing appreciation, it can take a while. Now, the last 3 to 4 years when we were in the pandemic were a little bit different. We saw some pretty astronomical appreciation, which is uncommon, I'd say, for the space in general. And so when I first bought my very first property, I was constantly on Zillow, checking this estimate, looking to see what the value is, how to appreciate over time. And like it was never on a day-to-day basis amazing. But I tweeted about it this morning. I bought a house, my very first house, it was turnkey, and 7 years later sold it for more than double what I paid for it. And so over a long enough time horizon, the appreciation can be amazing and massive, but in the short term, it tends to be slower. And same thing for value add. If you are doing a project to a particular property, you can obviously it's called forced appreciation, so that can happen a little bit quicker, but depending on the size and scope of the project, it still may take a while. And so anybody that's familiar with my story knows that I took on this insane redevelopment project that ended up taking like 3 years. And so it wasn't just a quick in and out 6-month type of project. This was a really big lift and a big deal. And so once the construction was done, I then had to get tenants in the property that then had a history of paying rent in order for that value to be added and essentially counted. So these things can really take time. And so I wish I would have known that as a younger investor, of like, just be patient. Just be patient.
I dig it. Patience. I'll go ahead and jump into my number 3 thing. And this is going to be, again, on that decision-making kind of framework. And I was, in preparing for this, I kind of had some notes. So this is a way to kind of think a little bit more strategically about decisions. Is some decisions are one-way doors in that you make them and you kind of got to live with them, and other are two-way doors in that it's pretty easy to adjust, or the results of choosing one or the other is inconsequential, or it's like minor, especially like thinking about patience long term. So like an example of this, like a 2-day door is oh, I'm on a turn, I have to decide if I want to put granite counters or replace or whatever, those kind of like, while there might be, hundreds or maybe like 1,000 or some kind of dollar amount associated with that decision, ultimately it's not going to be very meaningful to my long-term portfolio. A more of a one-way door, like, so I would categorize that as kind of like inconsequential, like not as important. More of a
Yeah.
one-way door would be like the decision around a property manager. Sure, you can change them, but there's just a lot of like friction and pain. So in applying this to as an investor, what I would tell myself is like, all right, Tom, like if you have a decision to make and it's easy to change or it's inconsequential, that's a two-way door. Make a decision with the best information and just run with it. On those one-way doors, take a little more time and do that extra diligence. So tying this back to an earlier point around going the extra mile on relationships and making those decisions, it's on those one-way doors to put the extra time and effort in. So in any decision that comes up, knowing is it a one-way door and a two-way door, and appropriately applying that amount of effort and resource into making those decisions.
I love this, Tom. This is so good. Like when I think it was my third investment property ever. It was up in Ketchikan, Alaska. And I was grinding, spinning my wheels, trying to get all these questions that I had answered. And I wanted to know every little thing and have such a high degree of control over everything. And I was making myself sick. And had I known you at the time, or had I had this perspective, it would have been so much better for me to think, okay, well, does this really matter? Like in the grand scheme of things, is this going to impact the investment? And then secondly, can I change my answer or change my decision down the road if I need to? That would have made things a lot easier for me.
I love the connective tissue of these different like themes, on how they're coming together. Because I mean, that sort of like patience, is this ties into that as well, where those less consequential kind of two-way doors. It's like, great, make a decision. Don't make sure you're spending your time on highest value. Yeah.
Totally. Okay, so then to take this a step further, Tom, as people who are listening maybe don't have the hindsight that you and I have, or the experience to look back and say, oh, okay, these are things I wish I would have known when I got started investing. How does someone listening know what's a one-way door versus what's a two-way door?
I think there's a couple of frameworks. I mean, ultimately, as an investor, everything, if you think about longest view possible, everything's a two-way door, right? I can buy a house, I can sell a house, I can hire a property manager, I can fire, I can, do that stuff. So I think about it just amount of like effort and work and maybe time horizon. So maybe a good framework is like, oh, am I going to be thinking about this in 6 months? I think there's a lot of different, but I mean, I would say this is just more of a tool in your basket around not getting caught in paralysis by analysis by just applying this framework. Like, well, you know what, in 6 months or a year, oh, sure, I maybe could have saved a few $100s by selecting XYZ or blah, blah, blah. Where the much more consequential decisions, like which house you're going to buy, if you're going to sell, which property manager you're going to hire, all this yada, yada, yada. Like those ones you just want to allocate a little more, I guess, mental bandwidth for those types of one-door decisions.
I dig it. No, I think that's great, man. I think that's great.
Number 4.
Okay, my third one, the tax benefits of real estate investing are incredible. I think this is something that I knew at the time, like kind of tangentially when I first started learning about investing and first started investing. And it was like monumental in how it impacted my taxes and my overall financial picture. And I think had I known more about that, I would have run harder at this probably sooner and may have done a few things a little bit differently when it came to setting up my taxes and how I structured things. And so I think just as newer investors are getting started, this is really important to be thinking about, because especially in today's high interest rate environment, the returns that people are seeing in terms of their cash on cash return, in other words, how hard your dollars are working for you on a percentage basis, has been a little bit muted. And so if you're thinking, oh man, I'm only going to earn 5% on my money that I've invested into this deal, why would I do that when I could go stick my money in the stock market and get 8%, say, or in a high yield savings account and get 5%? Doesn't seem worth the risk. Well, if you are aware of how impactful the tax benefits are going to be for you, that could easily take that 5% and make it a very worthwhile investment for you because of this cherry on top, these cherry on top benefits. And so I think for what I would tell myself is just take a step back if you are having wavering about making the decision about investing in real estate, whether or not it makes sense for you. Understand what the tax implications are for your particular situation and watch yourself be amazed.
Is there a particular, not to expound upon it too much, but just like a little carrot of like a specific tax related maneuver that, kind of turn the light bulb on?
Yeah. So for me, I have debt on all my properties. I don't think I own anything in cash fully. I've got debt on it. And so there's cash flow that comes off these properties after all the expenses are paid. So I pay my taxes, insurance, property manager, repair and maintenance, and then my mortgage. And then there's still money left over that goes into my pocket. Well, there's this thing in the tax world called depreciation, which basically says you get to take roughly 80% more or less the cost of the property and then depreciate that on your taxes against the income the property makes. And so what that ends up doing for me in most of my scenarios is I have a negative paper loss at the end of the year in terms of my taxes, but I have actual hard dollars that are going into my pocket that I can spend and use today. So in essence, another way to say this is most, if not all of the income that's going into my pocket from real estate is protected from taxes fully.
Yeah.
So I get essentially tax-free money that I get to use and live off of and spend in my everyday life because of the fact that I own rental real estate. And so when you start to realize this, like, oh my gosh, this is unreal. So again, just taking a step back and understanding how investing in real estate could impact your financial picture and your tax situation could take that maybe measly return that you're thinking about and kick it up a notch. In the words of Emeril Lagasse.
Yeah. Kick it up a notch.
Kick it up a notch. Bam.
I wasn't going to use this as my like 5 things I wish I had known. But sure, I will.
You could have 6. Why not?
I could have 6. Well, no, this will be 4. This will just count as 4. Let's see yours around like hidden benefits. So like in all of these models, that I have in underwriting, like there's going to be a lot of blindsided benefit, like what Michael's talking about related to taxes. Another one is just the loan paydown piece, like I never like underwrite that like, hey, I'm going to go borrow, 80 grand and someone else is going to pay it off so that at the end of the mortgage, like, I'm not underwriting that as part of cash flow or return or whatnot. Like that's just like straight kind of blind benefit. So like loan paydown is something that I didn't necessarily think about too much in like initially when I got into it, but in thinking about it, I don't know, like a decade into some of these mortgages, like shoot, like I've paid down like, a third of $100,000 that, I borrowed in my name and somebody else paid off. Like, that's kind of like a wild benefit that isn't even, necessarily modeled out in initially acquisition. So kind of all the blind benefits. Yeah.
Yeah, and I think kind of getting back to one of our earlier points is like the patience piece of this, and that it doesn't happen overnight. And so when you look at an amortization schedule or a payment schedule of a mortgage, it has 2 pieces. It has the principal piece and the interest piece. And at the beginning of the loan, your payment is mostly interest. And given the size of the interest rate too, that can have a major impact on the sizing of those 2 pieces. But at the beginning of the loan, it's mostly interest. You fast forward 5, 10, 15 years, that slider in terms of how the payment is weighted between principal and interest starts to slide more heavily towards principal. And you just start getting this principal pay down aggressively in the second half of a loan life. And it's mind-boggling because the payment doesn't change if you've got a fixed loan, right? If you got a variable rate, that could change. But on a 30-year fixed loan, like you just said, at the end of 30 years, someone will have just paid that off for you.
Yeah. The one that replaced was taxes of just, I didn't realize how big of a pain in the butt it was to prepare all the tax stuff. So it's like with all of these units, it's like, all right, get the cash flow, get the 1098 from the lender, get the 1099 from the property manager, get the payment of the insurance, get all the work order costs. And it's like, oh, it's worth doing because you're getting that benefit. But like, man, it's like almost like a full day of like just tracking stuff down and better ways that I can organize and go about it. But that was unexpected, kind of overhead in my life of an investor, of all the work required to send to my CPA, every
Yeah. No,
March or whatever. Yeah.
I totally hear that.
Yeah.
But is it worth it in the end?
Sure. Yeah, absolutely. It's gosh, yeah. Yeah, absolutely. Go ahead, Michael. Let's hear number 4.
All right, number 4 for me is that it's going to be more difficult than I initially thought to retire on cash flow alone. Appreciation is really, in my opinion, what ultimately makes that possible. And what I mean by that is when I was first getting started investing, I was so focused on cash flow, cash flow, cash flow, cash flow. That was the name of the game for me. If it didn't cash flow, I wasn't interested. Well, now fast forward a couple of years, I've owned properties that are super cash flow heavy, and I've owned properties that are less cash flow heavy. And the ones that are less cash flow heavy tended to have appreciate more over time and add more equity into my pocket or net worth than the cash flow properties. And I'll just share some numbers with people. So that very first property I purchased that I was sharing with you guys that I sold after 7 years and it doubled in value, I bought it for $295. It cash flowed like $100, $150 a month. And then I sold it for $615,000 7 years later. And so if we look at the cash flow component of that, it was whatever, $1,200 a year, call it, over 7 years. I don't know, 10 grand, 11 grand, something like that in terms of cash flow. But in terms of equity was hundreds of thousands of dollars over that same period. And so that I could then take and go invest into a cash flowing asset, which would be much more impactful than that $100 a month. And so I think as you're growing your portfolio and as you're scaling your portfolio, it's important to have cash flow to play defense because you don't want to be coming out of your pocket every single month to pay for this thing, depending on what your investment thesis is. Mine is always to have some cash flow covering itself, but to really focus on the appreciation side of things. And if I had done that more so, portfolio would be in a different position today. And so I think people need to understand, like, yes, buying cash flowing real estate is an amazing thing to do, but I would think it's important to have a strategy in place around, okay, well, how do I get to my financial independence number? Or how do I get to my cash flow number? And what types of properties do I need to be buying to get there? And it might not be as linear path as we all want to make it out to be of, oh, I go buy 10 cash flowing rentals and maybe it's I buy one appreciation play, sell that 1031 exchange into something that cash flows better, and then leverage that cash flow into something else. And so I was always of the linear mindset. I go do this and then therefore this. And it's not as smooth or linear as I thought it was.
Yeah, I like it. I'm going to piggyback right on that one with my 5th one. And, I wouldn't say this is necessarily one that I wish I knew. I feel like I had a pretty good handle on it. But just the importance of not getting enamored on certain cash flow metrics and thinking about stuff in balance around school scores and other kind of crime indicators. I have a friend who was really excited about some high cash flowing stuff, but it's man, that property is right by the airport. All kinds of little indicators that are sometimes that are less consistent around vacancy and, not necessarily getting the type of appreciation that Michael is talking about. So, again, I think I was career-wise had a lot of exposure to the importance around safety balance around, don't get enamored with certain metrics or vanity and have them all in context. And, in doing the research and taking time and underwriting properties, you can get your cake and eat it too, but not to just get over enamored into certain return metrics and thinking about them in context of other type of risk type metrics. So, yeah, that would be my final one to close it out.
I think that's so good, Tom. And I don't know if you remember, but so when we worked together at Roofstock, we developed this calculator for helping people make buying decisions.
Yeah,
and it was one of the first times when you were talking about school scores and all these other risk factors. And I'm scratching my head. I'm like, what is he talking about? School scores? That's never something I've considered. Because I was that investor that got so enamored with the numbers. And I was like, if the numbers make sense from a cash flow perspective, I'm like, I don't care. And it was because my purview was pretty narrow. And as we worked together and I learned and developed my investing thesis a little bit more, I realized oh, there are these other factors that are really at play. And so it's important to look at things holistically and not just get pigeonholed and focus on a particular thing. So I love that, man.
Totally. And what was fun about that specific model that I encourage people to do is, sure, like you can go to areas where, perhaps the school scores or whatever are a little bit lower, but your expectation of return should be so much higher. Like, if I'm looking at like a, class A, class B, class C kind of areas, like I should be okay of buying a house with a lower return in class A and so on and so on. So having this kind of full view of, the way that you underwrite is important. And, some of those return variables should be better in areas that are riskier. Like it's like an inverse relationship.
Risk versus reward.
Yeah.
You got to get rewarded for taking more risk.
Yes.
Oh, that's great, man. Okay, my fifth and final is that investing in real estate is both not as hard as you think, but also not as easy as all of the social media influencers make it out to be. I think it's somewhere more in the middle. And so it's not just something you wake up one morning and roll over out of bed and decide, I'm going to go invest in real estate. It does take a little bit more, I would say, nuance and experience and attention to detail and just learning than that, unless you have just a ton of money to play with and don't really care. But I would never recommend it, even if that is you. But I also think it's a little bit more complicated than that. And it's also just hard as I think so many people make it out to be. Like, you don't have to pick up your phone at 2 a.m. when your tenants call you because there's a leaky toilet, because my tenants don't have my phone number because I use a property manager. And so there's the extremes on both ends, and the reality, as it so often is I think somewhere in the middle. And so understanding that and not being so naive to think, oh my God, this is so easy, but also not being overwhelmed and getting stuck behind my own self is super important. And I wish I could have shared that with my younger self and anyone listening that's just getting started.
Yeah. I mean, such value to, walking before you're jogging, before you're running. So, toe dipping is a good term, and, and interested in getting into it. Like, great, start small, learn. And as you get comfortable, go.
Yep. I love it. Well, Tom, should we get out of here?
Yep. Sounds good.
Awesome. Thanks everyone for hanging out. Hopefully this was helpful, especially if you are just getting started, to hear a little bit of hindsight from Tom and myself. As always, we love hearing from you. Ratings, comments, reviews, subscriptions are really helpful for us, and we look forward to seeing you on the next one. Happy investing.
Happy investing.